Good morning, everyone. This is Andy in Business Development, and this is Monday Mortgage Minute. Well, today, yes, once again, we're going to talk about the Federal Reserve dropping their key interest rate. As you have already seen, they dropped their key interest rate on Sunday, and that was an effort to do it before the markets opened, and the markets completely rejected it this morning, including the Asian market that was open while we were still sleeping last night. Asian market, European market, and the US market when open all rejected the plan. I'm sorry, I shouldn't say rejected. They're like, yeah, okay, that's great. However, slide, sell. So the markets are still in turmoil, I'll say lightly, but I want to talk about specifically what that means for you that the Fed has dropped their rate. Now, we've already been telling you for weeks that it affects short-term lending, like car loans, interest rates for credit cards, lines of credit, student loans, that kind of thing. But what this means in what they did is they're injecting $700 billion into two key things. The first thing is treasuries, and the second thing is mortgage-backed securities. So those of you who've been following us and I've been telling you, hey, when more money comes to mortgage-backed securities, rates go down. And that's what happened a couple of weeks ago when we had that really quick dip in rates and that like really hard and fast refi pop and boom, but then that kind of stalled out. I'm gonna talk about that in just a second. So let's stay here. So first of all, when the Fed announced their rate cut yesterday, they said they're going to inject $700 billion into two things, $500 billion into treasuries, $200 billion into mortgage-backed securities. Now that mortgage-backed securities part is really, really important for us. That is new money coming into the market. That's fresh money coming into pools of mortgage money. And when there's more of something, it becomes cheaper to give out. So when there's more mortgage money, rates go down typically. Now, that's what we should expect for the months ahead. And why am I saying months ahead? Because in the Federal Reserve's comments, they said they will be doing quantitative easing for the next few months. That does not mean they're just gonna pump $700 million in right now or this week. It's going to be spaced out. That's why it's called quantitative easing. They're doing it methodically with a level of frequency and volume that won't completely flood the market all at once, but help to provide a slow, soft landing and hopefully some support for the market that it will actually have an appetite for and is willing to accept. So this is a really key move by the Fed, and it's going to help us, but we need to remain patient. Those of you who are on our private emailing list, we shared with you last week, there's three key things you can do to take advantage of the refinance market. Number one was be organized. Number two was be patient, which is what we're doing now. And then number three is be prepared to respond. And in that, we were talking about how it's actually going to be to your favor and our favor and working together that when things do ease up and rates do come to us where we need them to be and want them to be for you, that if we're organized and we're patient and waiting and then we're ready to react, we can actually move quickly into the process of closing your loan. What you should be aware of, though, is that the market in general and the underwriters and the banks, man, they're exponentially flooded right now. As someone else in our industry said last week, it's like a Home Depot during a hurricane. There's just so many people that came through the front door all at the same time. It literally caused like this like screeching effect of like, wait a minute, there's so much happening. Plus you have the market that was going crazy. And so banks are like, wait, time out. We have like this influx of business that we can't handle. We have rates that were low, but then they went back up right away. So they were unable to actually give adequate pricing because it was changing so fast. And that's why you actually saw rates dip really quick and then come back up and now be higher than they were before. And part of that is because there was money that flooded the market, but then the market like tanked and they're like, well, wait a minute. Well, that's not gonna give us enough return or any return, so I'm not gonna put my money here. So money left mortgage-backed securities, plus banks got inundated with business, like, well, hold on. Let's give everyone our go-away price, which is 4.5% or 5%. Well, that'll keep people from refinancing. That happened too. And then what really that meant is that, you know, people were searching for the Fed and the government to step in and do something, which now they're doing, and that is going to be the whole thing I'm talking about right now, which is injecting new money into the marketplace, into mortgage-backed securities specifically. So That's why you saw a very, very short window of the blip in refinances from 2 weeks ago when we first gave you the Fed rate update video like this. And it happened, and we got a lot of people coming through the front door, and most of you were able to lock. A few of you were still going to remain patient, and we're going to wait. The market went against us there for a little time, but it's now going to ease and come back into stability where we want the market to be to help you to save money. So if you have specific questions about how this affects you and your loan, you can reach out to us. You can leave a comment below, you can email, or you can call the office, and you can talk to William, you can talk to me, and we'd both be happy to explain any of this to you and talk about how this relates to your situation specifically. All others, if you have a general question you want me to answer, you can put that below and I'll be sure to answer it either in an upcoming video or online, wherever you're seeing this. And we thank you guys for watching. Please share this with somebody who needs to understand what this means for them. In general, keep your eyes open and be ready. We are going to see rates soften and ease a little bit. It will be over the course of the next few weeks, and the Fed's participation in buying mortgage-backed securities will be over the next several months. So remain patient, but be ready. And when the time is right to strike, we got to go for it. Okay? Thank you guys for watching. Have a great week, and we'll talk to you again soon.